If you're over 60 and collecting Social Security, there's a silent trap waiting in your retirement income, one that quietly drains thousands of dollars every year from good, hard-working seniors. You won't get a notice in the mail. No letter from the IRS. No flashing warning on your tax return. Just less money in your pocket, month after month, year after year. As a financial advisor, I've seen it happen far too many times. Not because of bad investments, overspending, or scams, but because of something most retirees think is safe, their Social Security check. Yes, the very benefit you worked your entire life for, the one meant to support you, is being taxed in ways that catch seniors completely off guard. It's called the Social Security tax torpedo, and it's one of the most misunderstood traps in retirement planning. Here's the shocking truth. If you collect Social Security while also withdrawing from a 401k, IRA, or even earning part-time income, you could be pushing yourself into a hidden tax bracket, one that effectively taxes your Social Security up to 85%. And it doesn't stop there. The chain reaction can trigger higher Medicare premiums, loss of deductions, and even penalties you never saw coming. I'll never forget one of my clients, Mr. Thompson, a 72-year-old retired teacher. He did everything right, saved diligently, paid off his mortgage, and started his Social Security at 66. But last year, he came into my office with a shocked look on his face. His tax bill had jumped by nearly $3,000, even though his income hadn't changed. What happened? His required IRA distribution pushed his provisional income over a hidden threshold, activating the Social Security tax torpedo. It meant 85% of his benefits were now taxable. He told me, "I thought Social Security was supposed to be tax-free. I never knew this could happen." And he's not alone. Millions of retirees are unknowingly walking into this trap every single year. Make sure you like this video and subscribe to Senior Wealth Tips, where we break down the hidden traps most advisors never tell you about. In this video, I'm going to show you exactly how the Social Security tax trap works, the income thresholds that trigger it, real examples of seniors losing thousands, and the smart moves to legally avoid it. Because the truth is, this trap isn't your fault. The IRS never makes it obvious. But if you understand the rules, you can keep more of what you've earned. Let's start by pulling back the curtain on how this tax torpedo is calculated, and why so many seniors fall victim without even realizing it. Most retirees are shocked when they realize how sneaky the Social Security tax trap really is. It doesn't show up as a single line on your tax return labeled trap. Instead, it hides behind a formula so confusing that even many accountants gloss over it. It's called provisional income, and it's the key to understanding why your Social Security check is quietly being taxed more than you expect. Here's how it works. The IRS doesn't just look at your total income. They use a special formula that adds together half of your Social Security benefits, your adjusted gross income, and any tax-exempt interest, like from municipal bonds. That total is your provisional income, and it's what determines how much of your Social Security is taxable. The thresholds are shockingly low, so low that even modest income can trigger taxes. If you're single and your provisional income is between $25,000 and $34,000, up to 50% of your benefits become taxable. Go above $34,000, and up to 85% of your benefits can be taxed. For couples filing jointly, the danger zone starts at $32,000, and above $44,000, 85% of your benefits are taxable. These numbers haven't been adjusted for inflation in decades. That means what used to affect only high earners now hits almost every middle-class retiree. A small pension, a part-time job, or a required minimum distribution from your IRA can push you over the line before you even realize it. Let's walk through an example. Imagine you and your spouse collect $40,000 in combined Social Security benefits. That's $20,000 counted toward provisional income. Add $25,000 from your IRA withdrawals and $5,000 in tax-exempt bond interest, and suddenly your provisional income is $50,000. That puts you squarely into the 85% taxable range. So even though your total income is just $70,000, far from wealthy, you could owe taxes on $34,000 of your Social Security benefits. Depending on your tax bracket, that might mean losing $3,000 to $5,000 a year in extra taxes. And that's before considering how it bumps up your adjusted gross income and ripples through the rest of your finances. The trap doesn't end there. Once your adjusted gross income increases, it can trigger something called IRMAA, Income-Related Monthly Adjustment Amounts, on your Medicare premiums. So not only are you paying more taxes, you're also paying higher healthcare costs, all because of one invisible formula the IRS rarely explains clearly. It's heartbreaking to see how often this catches people off guard. Take Mrs. Green, a 74-year-old widow from Florida. She lived modestly on Social Security and a small teacher's pension. One year, she decided to take an extra $10,000 from her IRA to help her granddaughter with college. She thought it was a generous gift. Instead, it pushed her provisional income above the threshold, taxed 85% of her Social Security, raised her Medicare premiums for the next year, and cost her nearly $2,000 more than she expected. She told me later, "I wanted to help my family, not help the IRS." The sad part is, none of this happens because you're making huge mistakes. It happens because the rules are designed to be invisible until it's too late. You can't see the trap coming unless you plan ahead. And many seniors make it worse without realizing it. They start Social Security early at 62, then begin drawing from their IRA a few years later, stacking taxable income on top of taxable benefits. Or they sell investments without understanding how the capital gains will add to their provisional income. It's like stepping into quicksand. Each move pulls you deeper. The key is awareness. Once you understand how the formula works, you can build a strategy around it. That might mean shifting withdrawals to certain accounts, spacing out income sources, or using Roth conversions before claiming Social Security. But most people never hear about these options until the damage is done. Another hidden danger is the myth that Social Security is tax-free. That used to be true decades ago. But since 1984, benefits have been partially taxable, and since 1993, the 85% rule has applied. Yet those thresholds have never been indexed for inflation. So every year, more retirees get swept into the trap. Imagine you're living on $60,000 a year, half from Social Security, half from savings. That feels comfortable but modest. You might assume you're safe from high taxes. But once provisional income kicks in, your effective tax rate can jump dramatically, sometimes 30% or more, on each extra dollar earned. Financial planners call this the tax torpedo, because your marginal tax rate skyrockets even when your total income stays low. And here's the kicker, even if your Social Security check is taxed, you still don't get a higher benefit or any credit back later. Once those taxes are paid, they're gone for good. It's money you earned, now quietly siphoned away because of outdated rules. I've sat across the table from retirees in tears when they see how much of their benefit disappears at tax time. They thought they were careful, budgeting every penny, only to realize that their safe strategy triggered hidden costs. But it doesn't have to be this way. Once you know the signs, you can take back control. In the next section, I'll show you how certain common actions, like taking RMDs, selling investments, or even earning part-time income, combine to make the trap worse. And more importantly, I'll show you the simple steps to legally minimize your taxable Social Security, so you can keep more of what you've worked for all your life. Because you've earned this income. You deserve to enjoy it, not watch it vanish into the IRS's pocket. Stay with me, because understanding the next part could easily save you thousands every single year. Now that you understand how the Social Security tax trap works, it's time to see how everyday financial decisions can quietly make it worse. Most retirees don't realize that ordinary choices, things that seem small or harmless, can trigger a chain reaction that pushes more of their benefits into the taxable zone. It's not reckless spending or risky investing that causes the problem. It's simply the way income is structured in retirement. Take required minimum distributions, or RMDs. Once you turn 73, the IRS requires you to start pulling money out of your traditional IRA or 401k. Even if you don't need the money, you must withdraw it, or face a penalty of 25% of what you should have taken. Those withdrawals are counted as ordinary income. So, if you're already collecting Social Security, every RMD increases your provisional income, which can push more of your benefits into the 85% taxable range. Imagine you've carefully planned your retirement. You're collecting $36,000 a year in Social Security and taking small withdrawals from your IRA for living expenses. But the moment your RMDs kick in, your income spikes, and suddenly your tax bill does too. It feels unfair because you're not earning more, you're just following the rules. That's what happened to Mr. and Mrs. Ellis, a couple I worked with from Arizona. 4 years, they managed just fine on Social Security and a modest pension. But when they turned 73, their combined RMDs added $28,000 in taxable income. Overnight, 85% of their Social Security became taxable, their adjusted gross income jumped, and their Medicare premiums increased by over $100 a month each. They told me, "We didn't get a raise, but our taxes sure did." And RMDs aren't the only culprit. Many seniors also sell investments to supplement their income, stocks, mutual funds, or property. Even if those gains are long-term and taxed at lower rates, the capital gains still count toward provisional income. That means a single sale to cover a large expense, like a roof repair or helping a grandchild with college, can push you into the tax torpedo. Mrs. Dalton, a 76-year-old widow, faced this exact situation. She sold a portion of her mutual fund to pay for a new car, believing she was just using money she'd saved. The sale added $15,000 in capital gains to her income. The next spring, she was stunned to see her Social Security taxes jump and her refund disappear. No one had warned her that capital gains could make her benefits taxable. Even part-time work, which many retirees do to stay active or supplement their income, can have unintended consequences. A few $1,000s from consulting, freelancing, or a seasonal job can be enough to cross a threshold. You think you're earning extra, but after the taxes and higher Medicare costs, you might keep only a fraction of what you earned. It's not just income sources that trigger the trap, it's also how you take your withdrawals. Many retirees take money from their traditional accounts first because it feels easy. But that's often the worst move for taxes. Every dollar withdrawn increases provisional income. By contrast, money from a Roth IRA, a health savings account, or a taxable account with principal doesn't count toward the formula. Without a strategy, you can end up paying more than necessary every year. The real danger is how the trap compounds over time. Once your benefits are taxed 1 year, your higher adjusted gross income can raise your Medicare premiums the next. Those premiums are based on a 2-year income look-back. So even a one-time spike, like a large withdrawal or sale, can cost you for years afterward. It's not just about this year's tax bill, it's about every year that follows. And because the thresholds haven't changed in decades, inflation pushes more and more retirees into the danger zone. What used to be middle income is now treated as high income. That means even conservative savers who did everything right, worked hard, paid off their mortgage, lived modestly, are being penalized by outdated rules. I once met a retired couple, George and Linda, who thought they were being smart. They delayed Social Security until 70 to get the maximum benefit. But they didn't realize that by waiting, they were also increasing their taxable benefit later. When combined with their RMDs and pension, their provisional income soared. Their Social Security was taxed at 85%, and their Medicare Part B premiums jumped to over $230 each per month. They told me, "We thought we were planning wisely. We didn't know waiting would backfire like this." This is why proactive planning is crucial. It's not enough to save money, you have to plan how to spend it strategically. The order in which you draw from accounts, the timing of Social Security, and even the year you realize income all matter. Without a coordinated strategy, you end up paying more taxes and losing control over your retirement budget. The good news is, you're not powerless. There are ways to manage this. One approach is to start Roth conversions before taking Social Security. By gradually moving money from your traditional IRA to a Roth, you pay taxes at lower rates now, and future withdrawals won't count toward provisional income. Another strategy is to delay Social Security until after your largest taxable income years are over. Or, if you've already started, you can balance withdrawals between taxable and non-taxable sources to stay below key thresholds. But before you make any moves, it's essential to understand the full picture of your income. You need to know where you stand, how close you are to each threshold, and how small changes affect the outcome. Most retirees never see this clearly until tax time, when it's too late to adjust. In the next part, I'll show you exactly how to calculate your own provisional income and pinpoint the danger zones before they hit. We'll walk through a simple example so you can see how much of your Social Security might be at risk, and what you can do right now to protect it. Because once you know your numbers, you hold the power. Most retirees who fall into the Social Security tax trap never realize it's happening until they file their taxes and see the damage. And by then, the choices that caused it are locked in. It's rarely one big mistake. It's usually a series of small, innocent decisions that combine to create a costly outcome. The good news is, once you know what to watch for, you can stop making them and start steering your income in a smarter direction. One of the most common mistakes is taking Social Security too early. Many people start benefits at 62 because they worry the system might run out or they just want to enjoy what they've earned. But what they don't realize is that starting early locks them into a smaller monthly benefit and often pushes them into higher taxes. That's because while your monthly check is smaller, you usually still need the same amount of income to live. So you take more from your IRA or 401k, and that extra withdrawal increases your provisional income. The result, not only is your benefit smaller, but a bigger portion of it is taxable. It's a lose-lose scenario. I worked with a client named Janice, who started Social Security at 62 while still working part-time. Her paycheck, combined with her benefits, pushed her income high enough that 85% of her Social Security was taxed. After factoring in Medicare premiums and federal taxes, she was keeping barely 60 cents on every dollar. When we ran the numbers, we discovered that if she'd waited until full retirement age, she could have received a larger benefit and paid less tax overall. But once you start early, you can't undo the tax effect. It stays with you for life. Another big mistake is taking all withdrawals from one source, usually a traditional IRA. It feels simple, one account, one income stream, but it's one of the easiest ways to inflate your provisional income. Every dollar from a traditional IRA is fully taxable, and it stacks directly on top of your Social Security. A better approach is to balance your withdrawals. Take part from your IRA, part from a Roth account, and part from taxable savings. This mix gives you control and can keep you under the key thresholds. Overlooking Roth conversions is another missed opportunity. Many seniors avoid converting because they don't want to pay extra taxes now. But the cost of waiting can be far greater. By moving some money from a traditional IRA to a Roth before you start Social Security, you shrink your future RMDs and create a pool of tax-free income that won't affect your provisional income later. It's like paying taxes on your terms instead of the IRS's. I've seen retirees cut their Social Security tax bill in half with careful conversions in their late 60s. Selling investments without planning is another hidden trap. Many retirees sell mutual funds or stocks for a large expense, like a new car or home repairs, without realizing those sales generate capital gains. Even if those gains are taxed at a lower rate, they still count toward provisional income. One well-timed sale can turn a mostly tax-free Social Security benefit into one that's 85% taxable. That's why it's critical to plan big withdrawals across multiple years or use tax loss harvesting to offset gains. Then there's the myth of safe, tax-free income. Municipal bonds are often marketed to retirees as a way to earn interest without paying federal tax. But as you now know, that income still counts toward your provisional income. I've seen clients with $10,000 a year in muni interest trigger thousands in extra taxes on their Social Security. It's not that these investments are bad. They just need to be part of a bigger plan. Another common oversight is ignoring Medicare's income thresholds. Many retirees think of taxes and healthcare as separate issues, but they're deeply connected. Higher provisional income raises your adjusted gross income, which can push you into a higher IRMAA bracket. That means higher Medicare Part B and Part D premiums for the next year. Even a single year of extra income, like a Roth conversion done too quickly or a one-time property sale, can raise your premiums by hundreds of dollars a month. Timing also matters. Taking large withdrawals or selling assets late in the year is a frequent mistake. By the time you realize the effect, there's no chance to adjust because the year is over. Smart retirees plan their income in January, not December. They know their provisional income target and adjust monthly withdrawals to stay within it. There's also the emotional side. Many retirees think reducing income means reducing lifestyle, so they avoid making changes. But often it's not about earning less, it's about shifting where income comes from. You can enjoy the same lifestyle with a smarter mix of income sources that minimizes taxes. Lastly, too many people rely on outdated rules of thumb. They might have heard from a friend that Social Security isn't taxed, or that more income is always better. These half-truths lead to frustration and surprise bills. The tax code changes, thresholds stay frozen, and what worked 20 years ago doesn't work now. The truth is, the Social Security tax trap isn't just a math problem, it's a mindset problem. Most people focus on building savings, but they never learn how to withdraw strategically. Retirement isn't about how much you make, it's about how much you keep. Once you identify these mistakes, you can correct them. You can delay Social Security strategically, use Roth conversions in your 60s, coordinate withdrawals across accounts, and spread income over multiple years. You can also use charitable distributions directly from IRAs to reduce taxable income if you're giving anyway. In the next part, we'll look at the strategies that go beyond avoiding mistakes, the proactive moves that can help you escape the tax torpedo completely. Because once you understand how to work with the system instead of against it, you can turn your Social Security back into the reliable, tax-efficient benefit it was meant to be. Escaping the Social Security tax trap starts with one word: strategy. The system isn't designed to favor you, it's designed to collect. But with careful planning, you can turn the rules to your advantage. The goal isn't to eliminate taxes entirely, that's rarely possible. It's to minimize them legally and consistently so you keep more of the income you've worked for. And the best time to start isn't when you're already in retirement, it's in the years leading up to it. One of the most powerful tools available is the Roth conversion strategy. Before you claim Social Security, consider gradually moving money from your traditional IRA into a Roth IRA. Yes, you'll pay taxes on the converted amount now, but once it's in the Roth, it grows tax-free and withdrawals don't count toward your provisional income later. By the time you start collecting Social Security, you'll have a pool of tax-free money you can draw from without triggering the tax torpedo. The key is to convert in controlled amounts, just enough each year to stay within a comfortable tax bracket. Many retirees choose to do this between ages 60 and 70, especially after they stop working but before RMDs begin. Another approach is to delay Social Security strategically. Every year you wait past full retirement age increases your benefit by about 8% until age 70. That means a larger guaranteed income later, and more time to draw from your savings while keeping provisional income lower. If you can fund those early years with taxable savings or Roth withdrawals, you may be able to collect your benefits later when your taxable income is smaller, reducing how much of it gets taxed. You can also coordinate withdrawals across multiple accounts. Instead of taking everything from your traditional IRA, consider combining sources, part from Roth, part from taxable accounts, and only what's necessary from traditional accounts. This mix gives you control over your provisional income and helps you stay below critical thresholds. A withdrawal plan that looks balanced on paper can save thousands in taxes when designed around the IRS formula. If you're already past the point of delaying Social Security or converting to Roth, there are still options. One often overlooked tool is the Qualified Charitable Distribution, QCD. If you're over 70 and a half, you can transfer up to $100,000 directly from your IRA to a qualified charity. It counts toward your RMD but doesn't appear in your taxable income. That means you can meet the IRS's withdrawal requirement while keeping your provisional income lower and reducing taxes on your Social Security. It's an especially powerful strategy if you're already giving to charity anyway. Another tactic is income smoothing, spreading taxable events over multiple years. Instead of taking a large lump sum withdrawal for a big expense, break it into smaller amounts across 2 or 3 years. The same applies to capital gains from selling investments or property. Planning these moves in advance keeps your income steady and prevents sudden jumps that trigger taxes on your benefits or raise Medicare premiums. For those with pensions, there may be an option to adjust withholding or payment schedules. Some pensions allow partial lump sums or flexible payment timing. By coordinating those with your other income, you can reduce spikes that push you over thresholds. Don't overlook the importance of tax-efficient investing. Interest from taxable bonds or CDs adds directly to your income each year. Replacing some of those with growth-focused investments or municipal bonds in the right accounts can reduce annual income. But remember, municipal bond interest still counts toward provisional income, so they belong in a coordinated plan, not as a one-size-fits-all fix. You should also revisit your Medicare premium planning. IRMAA surcharges are based on income from 2 years prior. That means your 2025 premiums are based on your 2023 tax return. By monitoring your income now, you can prevent surprises later. A well-timed Roth conversion, charitable gift, or even delaying a sale can make a difference of hundreds per month in healthcare costs. Another strategic move is tax bracket management. Many retirees focus only on staying under the Social Security thresholds, but ignore how close they are to the next tax bracket. By understanding both, you can decide exactly how much income to recognize each year. Sometimes it's worth intentionally taking a bit more income in a low tax year to reduce future RMDs and avoid higher taxes later. For example, a couple in the 12% tax bracket might convert an extra $20,000 to a Roth this year while rates are low. That move could save them far more in future years when higher income pushes them into 22% or 24% brackets and makes their Social Security 85% taxable. If all this sounds complex, it's because the system is. But complexity also means opportunity. Each rule that traps the unprepared can benefit the informed. The IRS publishes the thresholds. It's up to you to stay below them when it matters. What ties all these strategies together is timing. When you take, income matters just as much as how much you take. The order of withdrawals, the year you claim benefits, the sequence of conversions, all influence your long-term tax picture. A few small changes now can compound into thousands saved over a decade. In the next section, we'll examine how to build a clear action plan, step by step, so you can see where your money will come from each year, how to track your provisional income, and how to adapt as tax laws or personal needs change. Because retirement isn't a set-it-and-forget-it journey. It's an ongoing strategy to protect your income from silent losses, and it starts with knowing exactly where you stand. Now that you understand the tools and timing, it's time to turn strategy into a concrete plan. The biggest mistake retirees make isn't a lack of savings, it's not knowing how to coordinate their income year by year. Without a roadmap, you drift into higher taxes without even realizing it. A proper plan puts you back in control, ensuring every dollar you receive is working for you, not against you. Start with a clear picture of where your income will come from over the next decade. List your Social Security benefit, any pensions, and all your investment accounts, traditional IRAs, Roth IRAs, brokerage accounts, savings, and annuities. Then write down when each source will start and whether it's taxable, partially taxable, or tax-free. This simple inventory becomes the foundation of your income plan. Next, project your provisional income for each year. Use the formula you've already learned. Half your Social Security benefits plus all other taxable income and any tax-exempt interest. Do this before you make withdrawals or sell assets. When you see the number on paper, you'll know whether you're approaching the danger thresholds. Treat those thresholds like guardrails. Crossing them means you're losing more of your benefit to taxes and potentially raising Medicare premiums. Once you see the pattern, start mapping your withdrawals strategically. If your provisional income is nearing $44,000 as a couple, consider pulling less from your IRA and more from a Roth or savings account. If you know a large expense is coming, like a new car or medical bill, plan ahead. Maybe you take a larger withdrawal this year and reduce next year's income to balance the effect. The key is foresight, spreading out the taxable impact so no single year pushes you into the torpedo zone. Another step is to segment your savings into buckets: short-term, mid-term, and long-term. The short-term bucket covers living expenses for the next 2 years, usually held in cash or low-risk investments. The mid-term bucket funds the next 5 to 7 years and may include conservative bonds or CDs. The long-term bucket is invested for growth and can include stocks or equity funds. By structuring your money this way, you can withdraw from safer sources during market downturns and avoid selling assets at a loss, which can also spike your taxable income. Review your plan annually. Every year, before taking withdrawals, estimate your income and taxes. Look at how changes, like inflation adjustments to Social Security, RMD increases, or investment performance, affect your provisional income. Adjust as needed. Retirement planning isn't static. It evolves with your life. Don't forget about Roth conversions as part of the plan. Decide how much to convert each year while staying in your desired tax bracket. Some retirees do fill the bracket conversions, converting just enough to reach the top of the 12% or 22% bracket but not beyond. Over time, these small moves can dramatically reduce future RMDs and lower taxes on Social Security. If you're charitably inclined, build qualified charitable distributions into your annual plan once you're eligible. Set aside part of your RMD to donate directly. It's one of the few ways to meet IRS requirements while keeping provisional income down. Also, keep a close eye on Medicare IRMAA thresholds. These income brackets determine whether you'll pay extra premiums, and they reset each year. Your tax return from 2 years ago determines your current premium. So the income you generate this year could affect healthcare costs in 2027. Including these thresholds in your plan ensures you don't save on taxes only to lose the savings to higher Medicare bills. Another overlooked step is tax withholding. Many retirees underwithhold on IRA distributions and end up owing a large sum at tax time. That can lead to penalties and cash flow problems. Coordinate with your tax preparer to ensure enough is withheld throughout the year, or make quarterly payments that align with your expected liability. For those already deep in retirement, it's not too late to act. You can still rework your income sources, adjust withdrawals, and make use of QCDs or Roth conversions if you have years before RMDs grow large. You can also use tax loss harvesting in your brokerage accounts to offset gains and reduce taxable income. It's also wise to involve a retirement-focused advisor or CPA who understands the interaction between Social Security, taxes, and Medicare. Not all professionals specialize in this area, so ask directly whether they model provisional income and plan around it. The right advisor can show you how small changes, like shifting $5,000 from one account to another, can ripple across your entire tax picture. And don't forget to factor in inflation and future tax changes. Current tax rates are historically low, but they're scheduled to rise in 2026 when existing tax cuts expire. That means paying some taxes now through Roth conversions might be cheaper than waiting. Your plan should prepare for these shifts, not just react to them. Finally, keep your plan simple enough to follow. Fancy spreadsheets and software don't help if you don't understand them. Focus on 3 things: how much income you need, where it comes from, and how it affects your taxes. When you can answer those questions each year, you'll always know where you stand. In the next part, we'll bring everything together: the mindset, the strategy, and the step-by-step actions, so you can move forward with confidence. Because the purpose of all this isn't just saving money, it's about peace of mind. When you know your income is protected, you can enjoy retirement without the constant worry of hidden taxes stealing what's rightfully yours. You've now seen how the Social Security tax trap works, why it happens, and how to fight back. But the final piece is mindset, understanding that protecting your retirement income isn't a one-time fix. It's an ongoing process built on awareness, planning, and small, consistent decisions. The seniors who thrive financially aren't always the ones with the biggest nest eggs. They're the ones who know how to use what they have wisely, anticipate hidden costs, and make the system work for them instead of against them. The truth is, the Social Security tax torpedo is not a sign that you've done something wrong. It's a symptom of a system that punishes savers and rewards confusion. You spent decades working, paying into Social Security, following the rules, and building your future. You deserve to enjoy that income without feeling ambushed by taxes you didn't expect. That's why understanding the rules is so powerful. Knowledge turns frustration into control. Start each year by reviewing your income sources. Ask yourself 3 questions. How much am I planning to withdraw? Which accounts will it come from? And how will that affect my provisional income? Don't wait until April to find out the answer. Project it in January. When you know your numbers, you can make adjustments before it's too late. Maybe that means delaying a withdrawal, splitting a sale over 2 years, or shifting funds from a traditional IRA to a Roth. Each small move is a step toward protecting your Social Security. Remember, the goal isn't to chase tax perfection. It's to create stability. A plan that keeps you below key thresholds most years will save far more than trying to react after the fact. Keep your eye on the big picture: steady income, lower volatility, fewer surprises. Taxes will always be part of retirement, but they don't have to control your future. Another powerful mindset shift is to view taxes as part of your return, not a separate issue. You wouldn't invest without understanding fees or risk. The same goes for taxes. Every dollar lost unnecessarily to the IRS is a dollar that could have funded travel, hobbies, or gifts to family. When you think of tax planning as income planning, you'll see it's not about spreadsheets, it's about quality of life. If you're already retired and feel trapped by the current system, know that it's never too late to adjust. You can rebalance accounts, use charitable distributions, or create a withdrawal plan that reduces your taxable income over time. Even small changes compound. A $1,000 reduction in taxes each year adds up to $10,000 over a decade, enough to cover vacations, home improvements, or healthcare costs. Stay alert to policy changes. Congress could adjust tax brackets, modify thresholds, or change how Social Security is taxed in the future. While you can't predict legislation, you can build flexibility into your plan. Keep some money in different tax buckets, traditional, Roth, and taxable accounts, so you can adapt no matter what rules come next. Flexibility is your greatest defense. Don't underestimate the value of professional guidance. A retirement-focused financial planner or tax advisor who understands the interplay between income, taxes, and Medicare can save you far more than their fee. Look for someone who creates multi-year tax projections, not just annual returns. Ask them to model different scenarios. What happens if you take more from your IRA, delay Social Security, or sell an investment? Seeing the numbers in black and white turns guesswork into clarity. It's also important to communicate with your spouse or loved ones. Make sure both partners understand where income comes from and how it's taxed. Too often, one spouse manages the finances, and when something unexpected happens, the other is left trying to untangle a confusing system. A shared understanding means shared confidence. Finally, remember why you planned for retirement in the first place. It wasn't to chase every tax loophole or worry over every line on a form. It was to create freedom, to spend time with family, travel, relax, and enjoy the life you built. Tax planning isn't about obsession, it's about peace. When you know your plan protects your income, you can focus on what really matters. So, take what you've learned and act on it. Review your income sources. Calculate your provisional income. Identify the traps in your own situation, RMDs, capital gains, unnecessary withdrawals, and start adjusting now. Each step you take puts more control in your hands and more money back in your pocket. If this series has opened your eyes to how much the Social Security tax trap can cost, imagine how many others are still unaware. Share this knowledge with your spouse, friends, or anyone nearing retirement. The more people understand these hidden rules, the fewer will fall victim to them. And if you found this helpful, let me know. Type 1 in the comments if you're ready to take charge of your retirement taxes. If you want more strategies like this, subscribe to the channel and turn on notifications. Every week, we break down the traps, myths, and opportunities that matter most to seniors who want to protect their wealth. You've earned your Social Security. You've earned your savings. Don't let outdated tax rules steal what you worked for. With knowledge, planning, and a little discipline, you can avoid the torpedo, minimize your taxes, and build a retirement that truly works for you. The system may be complex, but the solution is simple. Stay informed, stay proactive, and never stop protecting the income you deserve.